Good afternoon, everyone. This is Joshua Carmona, and welcome to the weekly SCORE webinar, learning how to jumpstart your business. Today, we're going to have Joel a little bit on the back burner. He's got something done to his
laryngitis.
He's got some laryngitis, so it's very difficult for him to speak, but he will be interjecting with us from time to time. We still have Kelly Wells down here. She doesn't want to leave, Joel. She wants to stay in Puerto Rico the rest of her life.
You bet.
That's easy.
Yeah. So let's get right into it.
I'll be down in a week, so I look forward to. I'll just have missed her. I think I arrive on the let's see what the date is, on Monday.
I think it's 18th.
Yeah.
Yes. So Joel, talking about demystifying your credit repair, this is as a presentation that you could use in your state if you needed to qualify as a CE course if you are in the mortgage affiliated business. Do you know anything about that, Kelly, as well?
Yes. I'm just getting ready to go through the course to get my CE certification so I can teach these classes. So it's very good when you're working with real estate agents to get them into your office.
What's the process around that, Kelly?
Well, in Washington State, we have to take a course, and it is a 16-hour course that we take, and then once we've taken the course, they give us our certification, and you have to enroll in a school. And the gal that I do the course from is the school, so then she will allow me to teach under her. And as long as I get it certified through the state, I can teach this course. Otherwise, I have to use what she's already got certified in credit.
Yeah, that's great, though, because you can have your own CE certification, and there's nothing better than to have another badge out there.
Right.
And engage possibly other similar referral agents in a group setting, and have them qualify for CE certification for I guess their renewals.
Right. They have to take a certain number of hours every year, and so you can get them into doing a class, and they will, you can charge for the class. You can charge $25, $50 a person, or you can do it and just get them into your office or your classroom, wherever you're doing it.
So this course, Joel, if I'm not mistaken, has been already approved in other states that you know of, right?
Yes, absolutely. It's been approved in Utah for one, at least.
Okay, good. So let's get into that. Can you hit the next slide, Joel? I've got no control. So when looking at this presentation, this is basically a course that's a presentation that's going to go after explaining what the FICO score is about and what are the myths around the FICO score. So it really lays into, it goes into the complete history of the FICO scoring model, including, one second here. Including, what they affect. So when you're giving this presentation, you're going to be engaging companies that are either doing business or are affiliated to insurance companies, to mortgage companies, automobile companies, and it explains how basically the whole FICO scoring model is going to affect their customers, for especially residential mortgage, and it'll help explain what credit worthiness is about and how is it scored and how to sustain it, what are the best practices around it as well.
Yeah, as you see, Joshua, there's just, a history of FICO score, a history of credit reporting, and how it affects you. And it kind of demonstrates that, you're the expert, about, the various information about the credit reporting agencies, and the fact, I think this is the next slide, that they're not an agency. They're multi-billion-dollar businesses.
Absolutely, in multiple countries, by the way. If you do if any of you are out there, go ahead and do a Wikipedia on Equifax TransUnion, and and Experian, and you'll see how many countries they're in. They're all over the place, and there are different corporate structures and entities as well. So these are definitely global companies.
Yeah, Experian is actually owned by London-based companies, actually on the London Stock Exchange.
Yeah.
Their U.S. headquarters is still Costa Mesa, California, but they also have a huge presence in Dallas as well. It's one of the reasons that so many credit repair companies come from Dallas is because a lot of them actually in some instances work for Experian. I've actually met a guy named Jim Charlet that owns a really large credit repair company out in Dallas, and he used to go to court and represent Experian when they were sued. And he said he woke up one day, he says, I'm just tired of doing this. I don't believe we're the good guys anymore. So he quit. He went in the credit repair business, and he and his wife were always invited to all of the golf tournaments and people's houses for Christmas and stuff, and the company told him to stop inviting him. So
wow.
He's been all of his friends that he had at the company won't even talk to him.
Yeah, yeah. So it's good to have that background information, because it's all about, with these types of presentations, Joel, it's all about establishing yourself as the expert. Now, a lot of people, when I say that, Joel, they really think that they have to present themselves as the expert with the consumer. And yes, that's important. But as an owner, as a high-end, as a manager of your business, you want to do business in bulk. And when the purpose of having a course like this available to you is to be able to establish yourself amongst your peers or their peers in their area of operation as the expert. That's even better, because now when you've got referral sources looking at you as the expert, they're going to preach that forward to their consumers, and that's what you really want to have happen. So this is the purpose of this course as well, and you can see the detail. It goes, it establishes what FICO, the Fair Isaac Corporation, is, has some chronology around that, when it was started, how it was started, and where it's at right now. So it's pretty interesting information.
Yeah, on the point of being the expert or being seen as the expert or holding yourself out as the expert, Dave Hirschman, who used to, I don't know if Dave is still in business these days, but he was a very well-respected coach in the mortgage industry back in the early 2000s, and maybe even earlier than that. And I said that to Dave one time. I said, people need to be seen as the expert. He says, Joel, let me tell you the biggest problem is that they need to, let me tell you the real issue, and he says that they need to become the expert and not just put themselves or hold themselves out as the expert. Even in our industry, there's a gigantic, force out there that really has read all the information that they know, and now they just regurgitate it as though that they're the expert. If you go one or two levels down below that knowledge base, they run out of steam. So the key here is to really learn this information, know this information, know where to go to get the information, and become the expert. Is the real key. Now, how do you do that, Kelly? Because you've been studying credit for a long time. So what are your recommendations on how to actually become the expert?
Well, you have to be careful as to who you're becoming the expert from, because so many times, everybody goes to the internet and Googles something and then takes that information as if it were truly all accurate.
Well, doesn't the internet have all accurate information?
That's right, it is, always. So, I've been very careful when I'm doing my research and what I'm doing to make sure that who I'm talking to really knows what they're talking about. I get a lot of information, and I just try to make sure that it's accurate, that it comes from a good source.
Yeah, very important. Because it's and that's very critical. And I have to give my buddy Jay Peters a tag here. Jay's book, Credit Secrets Bible, that was one of the finest books out there. And if you don't have it, you should definitely get a copy of it.
Yeah, there's badges as well that you can have. Like Kelly is certified with the CDIA. So am I. Back in I think 2006, 2008. I don't remember anymore. And Kelly and the CDIA has really been hit by the CFPB, and they've divided their FCRA certification into a two-type certification now, where now they have it for certain types of creditors and other types of creditors. I think original creditors and data furnishers that really are more of collection type of data furnishers. So they're starting to distinguish that, and they've divided that certification into two. But there are other certification paths that can add some great badges as well as great information. You know, the FICO scoring model, like Kelly says it depends on who you're getting that information. Well, I know, Joel, and so do you, that Kelly has been trained by John Altheimer. And John is one of the experts in this industry. He's been an expert witness in many litigation across the U.S. He's been on TV and he's continuously being interviewed on questions around the credit scoring models. But if you want to get a great base for that, you know, the FICO scoring model does have a certification track as well. And you want to write this down, everyone. If you go to allregs.com, that's allregs.com. You can search on that website and find a certification called a FICO Pro Specialist. That FICO Pro Specialist is not that expensive, and that is a great badge to have, and it explains how the FICO scoring model works in a basic way, and it gets pretty specific. So that's a great certification to have as well. There's also an association called the National Association of Credit Service Organizations, which is NACSO. And NACSO has a NACSO CROA certification for businesses offering credit repair as well. I'm also certified with them. You want to go ahead and take that training when you can with that association. And if you're out there and you want to join that association, you should do that as well. It's one of the more renowned and oldest associations that's been able to sustain itself in our industry. But definitely those are some places that you can get some qualified education, Joe.
Yeah, no doubt about it. And of course, you know, referring back to John Altheimer, I mean, he's one of the best guys out there, no doubt about that. So,
yeah. So you know, a lot of people. You know, we've got some statistics here. We've got as well as some why the credit scoring model. Okay, you know, let's talk about this for a second. You know, the credit scoring is a lazy man's method to evaluate your risk and default, non-discriminatory. You know, Joe, I had a conversation this morning to some of the consultants that we have on the island for SCORE at Vitech, and they were basically asking me, you know, what are the other industries that you could expand to? And you know, and I thought about that for a minute, and you know, we have a negative scoring system in our country, and in Canada as well. Most credit scoring systems out there are similar to the ones that, or mimic to the ones that have been put in place in the U.S. But there are places in the world, Joe, like Australia, that have positive scoring systems. So everybody, you know, in our scoring system, you pretty much you have no credit or bad credit until you have it. So it's more like you're in closer to zero than anything else until you've got enough to score on the model that ranges from 300 to 850. But with this positive scoring system in Australia, everybody's got, let's say, 100% until they prove that they have not, and then they fall on and then they only list the negative. They still have credit repair in Australia, by the way, and it's very expensive to have credit repair done in Australia. But I love this description. It's the lazy man's method to evaluate your risk, because it is. It was a scoring model that was invented, a list that had a model, a predictive model built around it, and it's fundamentally all negative from the beginning on. So it's very difficult to correct. But once you correct it, it's a score that's reflected in a snapshot. So and that's why I think we're looking at this presentation. It's non-discriminatory. What do you think about that, Kelly?
Well,
Yeah, I mean, exactly. The credit scoring, credit scoring model is a great barometer for our country, for people. When I was, I have some property that I rent in West Puerto Rico, Joe, and I used to have renters continuously just failing to make payment on them. So one day I just said, I'm just going to rent to only people that have over a 680 credit score. And it was funny because all of the people that I liked, when they actually asked me about renting the facility that I was trying to rent to them, most of the ones that I liked had terrible credit. And the ones that I really didn't like had great credit. And I started renting to those, and those never failed a payment. As a matter of fact, if they were ever going to be late, they called me with 30 or 40 days in advance to let me know that they were going to be a couple of days late, and they missed that next couple of days. They hit the next, that second postponement of the payment. So that's a great thing. So, this is a great barometer. It's not perfect, but it does work, Joe.
Well, I own a lot of rental property, and some of it is in Mississippi, some in Alabama, and what we've understood from the real estate agent that we have helping us with the property in Mississippi is that we're very stringent compared to other landlords, and I guess of individual single-family detached type dwellings versus apartment complexes. But on that very point, I mean, I want a FICO score, and I don't have a minimum, but it's got to be in the 600s for sure. And what I've always discovered is that if you don't pay your current bills, you're unlikely to pay me, okay? And then the second thing that we do is we always get a reference from your current landlord, and then we go 2 steps further. One is we look at payment shock, okay? So we had a couple kids living with their mother, going to get one of our houses is $1,350 a month. And they've been living at no rent expense, yet they didn't have the $2,600 or $2,700 for the first month's rent and the deposit to move in, to pay that up front. So they wanted to pay that over some time. So I'm thinking, so here's a problem, right? You've been living rent free, but now you're going to move into a $1,350 a month a house, and you don't have the $2,700. Okay, so that's what's called payment shock, and just from and literally that's the terminology for it in the mortgage industry. Is they look at that as a payment shock, and if they've been paying $700 or $800 or $900 a month rent, and they haven't demonstrated that they get saved that difference of that $500 or $600 every month, you'd call that payment shock too. So I know we're a little off the subject, but a part of being an expert is to go in and be able to talk about things like this in that mortgage environment and, do some discovery, because I'm a little further away from the mortgage space than I used to be, but, do some discovery first of all and ask the question, how are you guys treating payment shock these days? And, you'll have to ask the question 3 or 4 times to get, the basis of all the answers to find out what's going on these days. But, use that lingo as part of your repertoire of conversation with the mortgage people, and discuss that and be knowledgeable. Joshua, another good series of information to become the expert is the Consumer Law Practice Series from the National Consumer Law Center. You can go on their website, and I guess I bought something, so I keep getting order booklets of all the things that they've got. But I mean, it's just a great set of books. Fair Debt Collection is one of their books. Access, let's see, Credit Discrimination would be another real good one. Fair Credit Reporting, the new FCRA rules, new FTC interpretations.
Yeah, they've got their
that book's $190.
Well. Yeah, they've got their reports. Well, those reports are outstanding. I mean, they've done in 2006, along with the USPIRG, and these two associations are not affiliated, but they do represent consumer base. their consumer-based advocacy lobby groups in Washington, D.C., and actually the USPRG is all over the U.S. and has chapters in almost all 48 continental U.S. states. So they have a lot of good reports on there, and they publish reports almost every year, and they sell those. The National Consumer Law Center sells those, and they're very good. They're very good to have. They used to give some of them away, but now I guess they're cashing in on all of the data, But about in 2006, most of their information, not all of it, but most of their information was free. You can get very little free information from the NCLC now or the USPRG.
But in this book, they have free with your subscription to any of these books that you buy. There's the e-reports, over 100 online articles a year, and they would be great, free to anyone subscribing. So it'd be worth buying one of these books just to get those reports. So another real good piece of information.
Yeah, and think what you could do with that information if you could somehow digest some of it and create your own documentation off of that and other documentation to come up and produce pieces of content that you can use to engage your existing customer base or possibly any other customer base that can't, your leads that you want to engage week to week or month to month. The one other thing that I'd like to mention is the FICO scoring model is what lenders use to basically profile consumers on their probability to have a failed payment within the next 24 months, normally a 90-day late payment, now or greater. The problem is that, guess what, Joe? The consumers it's very difficult for them to see an accurate FICO score in all 3 credit reporting agencies. So that's very important that, within this presentation, it's talking about FICO because but normally consumers only see either a Vantage, or actually plus scores, and I don't think any of them use Vantage, but most of them use plus scores to look at. And that's interesting, that they get to see another range, another scoring model that goes anywhere from 300 to 990, and like the Vantage scoring model has 4 classifying classifications, A, B, C, and D. So it's just interesting to see that what the consumer sees is not what the lenders see, as well as how they're evaluated. So even though there is a relationship, it's very difficult to correlate.
Yeah, no doubt about that.
So looking at this, on this presentation, I've seen other presentations out there, Joe, that have, the 5 pieces of credit, the 5 factors of credit, however you want to call it. But the one I like about this is that it breaks it down on one screen and it tells you what is what: new credit, types of credit used, length of history, and it describes what falls into that, into each one of these types of things that are looked at in every one of these categories. And of course, the really important one is to talk about the amount owed and how managing your utilization ratio could affect could positively affect your FICO score and any other score for that matter. So it's just a good screen screen or page on this presentation to look at.
It's amazing when you're doing classes on this, and the most important seems to be the utilization or the amount owed. But I can't tell you how much time I have to spend talking to people about new credit or inquiries. It's like that is what they're concerned about, when in reality it's not hurting them as much as the other things, but they're just scared to death of the auto dealership that pulled their credit 25 times.
Yeah. Yeah, I used to get that question a lot as well. When in automotive automotive dealerships, what they do is they'll place consumers' name, address, and social inside a piece of software similar to like a dealer track, and they'll have maybe anywhere from 2 to 150 creditors out there that could probably give them some type of primary or subprime loan, and every one of those will inquire on their credit. So they could get up to 100 and some odd inquiries, but they're all soft, the first one is really the one that hurts his score. That's just interesting. I get that question all the time as well. With regards to payment history, this is really good information. Your late payments affect your score for about 24 months. And really, it's affect your score. I'd like to really, when you look at the FICO scoring model, according to John Alzheimer, it's really not you get points for everything. It's more or less you leave points on the table, and you don't take advantage of that if you're not, number one, profiled in the right way, and then, or what we call a scorecard, and then how you fare amongst everybody that's similar to you. So it's a statistical analysis of that. So paying your collection accounts that is more than 2 years old could hurt your score. Well, let's look at that. And why would you say that's true, Kelly?
Well, because when you pay that collection off, you're going to make the scoring model see it again as if it were it's going to update the last activity date on there, and then it will hurt your score.
So basically what you're doing is you're re-aging the account. It'll probably drop, depending on if it had an outstanding balance, it'll probably drop that balance and help out your score, but it'll affect your score because it could be re-aged at that time because it has a new DOLA, a new date of last activity. Okay, and that's a good thing. So that's, well, what do? You pay it off or don't you? Well, we recommend that, paying off any consumer should pay off their debts. I mean, they're not, the obligation that you have, legal obligation that you have, is something that you have to take care of because these accounts are just going to continue to get resold. One of the things that I see CROs do, Joel, is that they're worried about if they help their customers negotiate the debt. What they're really worried about is getting it removed. Well, quite frankly, Joe, a lot of these collection agencies are not going to remove that for you. That's not. Very few times have I seen that done. It happens, but it's very unlikely to have them say, well, sure, and have them place that in a commitment letter. What you really want to ask for is one thing that you can ask for is for them to say, well, don't say it was paid for less than the settled amount. Just say paid. That alone will help their score even greater, and that they're willing to do. So that's just a tidbit for all of you out there on this call. Ask not to to take it all off. Just tell them to ask them to say, well, say that it was paid instead of saying paid for less than settled amount or paid in settlement or settled for less than the amount. It's a good thing to do. What do you think about this other statement here? Derogatory accounts do not fall off of the credit report automatically after 7 years. They must be disputed. I think that's something that it can be true if the accounts are re-aged, especially on collection accounts. The date, we call that the purge date of an account. The purge date of an account is based on the last activity that account had, and that it's calculated to be there for 7 years based on the first delinquency of that case. So if you have a late payment, it'll start removing that late payment based on when it was delinquent, and then 7 years later it'll fall off. Now, if the account is put into, one thing is a late payment, but if the line item is placed into a derogatory status, that is based off of a purge date that is calculated. So it could seem that it could stay on for more than 7 years if collection agencies change that date. That is a very common thing. When collection agencies they should be taking over the last the date of first or last, actually date of last delinquency on the original account, passing it over into that first collection account, and they don't do it, Joe. What they do is they place in the date that they reported in there all the time, and sometimes it's that they don't know how to use the Oscar. Okay, but the reality is that they're re-aging customer accounts, and they've been called on that many, many times. Very common mistake that happens with collection accounts. This other thing with divorce decree The divorce decree does not take precedence over creditor agreements. I mean, if you're divorced and you signed, you've got a lien on something, on your property or whatever, and you co-signed on that, the bank doesn't care if you're divorced, or not. If you're separated, they don't care. Even if you're divorced, you still have a liability until that loan is basically liquidated, and then they could put that in somebody else's name or whatever. But if you're on that lien, you're there until that debt is completed or paid off. This is the type of information that you can provide a lot of your customers as well as affiliate referral sources as well. Great information.
Yeah, I think it's very good. And, of course, on that note, just on a personal note, my wife and I decided back in 2000 to have everything separate. So she's got her own, and we don't own any credit cards, and I don't even think own any bank accounts of each other's. Now, I think we're on there, but we don't sign. Well, let me just put it this way. I don't ever, use her credit card, or I don't ever use her bank account. So everything is just separate. And, everybody, a lot of people have these joint accounts. Well, things happen, and I think it's better to have everything separate. I have some relatives that were worth several $1 million, and because of the economic turndown, they had just bought one of their last subdivisions. They had about 15 houses under construction, and the entire market just went to what, and the end result is they basically having to file bankruptcy after all these years of great credit, great everything. You lose $3 million and the bank wants you to write a check for it. You're out of money, right? And
yes.
they did the stupidest thing, like the wife and the husband co-signed when they bought some piece of equipment, and I'm thinking, well, why did you do that? The husband and the wife co-signed on this, on probably all of the loans that they had, that they actually went that went into foreclosure, and that didn't have to happen, And so sometimes in their case it was this, everything, we're in this together, and what's good, what's mine is, I want to be on there, and I want to own 50% of it, and I want my part. There was a couple of different things in play for them to make that decision, but in retrospect, it was like the stupidest thing they ever did, because if the husband had just been on all those loans, which he could have been, and they could have moved the money to the wife's name and never had to, and had a financial disaster, of course, with the husband having to file bankruptcy, but not the husband and the wife.
Yeah.
So, I recommend that, if that's just good asset protection, and maybe beyond the scope of what most people deal with when they're talking to their clients. But I would recommend to everybody that they get their own credit card from their wife, and recommend that to your clients as well.
Yeah, that's a great piece of advice. I wrote an article on that in 2007, and preparing for preparing for your divorce and your credit. I wrote that it was in Spanish. I don't know if that's a great, divorce and credit, I think it was, and I got a lot of mixed emotions on that article. A lot of people didn't like it because I was basically telling them not for married couples to really build their financial lives separately. That's the best way. I went through a divorce, and I'll tell you, it's a problem. To this day, it's a problem. If my wife misses a payment on an account, or I miss a payment on an account that she's got or I got in the divorce decree, guess what? I've got to pay for it unless I want my credit to be affected. And well, that's not fair. Well, it doesn't matter what's fair. It's what was put into play a long time ago. Now, the reality is that a lot of the times when we go buy assets, we qualify for those assets individually, and the creditors or the loan originators just want to have as much guarantee as possible. So they're going to try to force you to put your spouse or anyone else on that note. If you qualify, lay that out there at the beginning and consult your consumers to do so. Lay that out there, have them put that out there that they want to do this on their own, because that definitely does burden them in the future if they do have a divorce. It's very difficult to split assets that way as well. You can split the assets, but you're going to carry a trailer on there until those assets are liquidated. And some of those heavy assets carry a 15 to 30-year term on that. You know, so it's, if you really want to get divorced, prepare for it beforehand. You know, think of risk, and nobody thinks about that because everybody's in love. You know, but this is great risk management.
And the other thing when I'm doing classes and I talk about this is it doesn't have to be a divorce. It could be a husband losing his job, or you know, going on to some kind of disability. And you have the ability that time, if you keep things separate, you have the ability to keep one person in that household with super clean credit. And then let the other person, like you talked about earlier, Joel, let the other person's credit. It doesn't have to mean going bankrupt, but it does mean that you can still have somebody that if you still need some type of a loan, you can go out and get it.
Yeah, it's great advice.
It's just good asset protection. And, you know, that's the basis of it. Asset protection really, as Joshua called it, risk protection. And what you're doing is called risk segmentation or liability segmentation. You know, we were just recently refinancing about 5 or 6 of our properties, and the bank said, as a lure to get my wife on the mortgage or on the promissory note, they didn't care if she's on the mortgage or not, said, we'll give you a 1/4 point lower rate. I said, you know, you couldn't give me a lower enough rate to encumber my wife on this mortgage, and you know, right? I'm thinking, you know, what a ploy, right? And so, you know, with the real estate market, we've ridden the thing down to the bottom, I hope, and of course, you know, the issue isn't making the payments. You see, the issue is with bank loans that are less than 30 years or 15-year bank loans. You know, every 5 years or every 3 years, they call the loan. Well, depending upon the pressure that the bank is getting from their regulators, you know, they may just unilaterally require you to make an equity infusion in the property. And if you know you own a lot of real estate, that's what's really happened. You own a lot of real estate, you got 15 properties, and they say, well, you got to write a check for $10,000 a piece. Okay, well, I can do that. Well, then 2 years later, they want another $15,000. And before you know it, see, they've just it's death by 1,000 ant bites. And so just another, kind of off the subject, but a point of what people are dealing with. And so when you go into these situations, you may want to ask, what happened? Did you own I see you own investment properties, and what happened to you? Did the bank call the loans, or and just again educate yourself generally to the widest range of issues that you can. Now, Joshua, how do you do that? Well, you try to do it proactively, but the way that it usually happens is that you begin to track the issues that your customers are having, write them down as a FAQ type of note to yourself, and then begin to fill in the answer to the FAQ. Go and educate yourself about that, and it may very well be you end up writing a book about it. You put the FAQs on your website. You begin to use that as content for your follow-up and campaigns, content for your PowerPoint presentation. So always be curious, kind of be the investigator. So when you run into a particular situation with a consumer's credit, ask them what happened and begin to kind of track the results of and the answers and the information that you may be able to use proactively in the future.
Yes, I agree. I agree. Looking at amounts owed, new debt does decrease score. That's important. One of the things that draws my that really consumers do this all the time is going over their credit limits. Right now, we need to strike that third bullet and correct this. But what we mean by this is that even $1 over can cost you a lot of points. We don't know how many because that's going to range differently depending on what scorecard you're in. But definitely, when you go over the minute over your balances, if that balance is your only balance, so really what we're trying to say is you've exceeded 100% on your global revolving debt, you've got a problem. So you've got to be very careful with that. HELOCs, home equity loans can be considered revolving debt if they're in the revolving debt category. So if they're classified as a revolving debt, then it will be a revolving debt. If it's classified as an installment account, well, it'll affect it in other ways, but not dramatically, as it won't affect the utilization score. Now, when we talk about utilization score or utilization ratio, we're talking about basically all of the cumulative outstanding credit that you have on revolving accounts that are open, and you divide your existing obligations to all of those by that amount and multiply it times 100, and that's your utilization ratio. I know a lot of you already know that on the call, but that is it's a global number. It really doesn't matter. You could have $10,000 credit on one credit card and have a $100 credit line and have 150 taken on that, and you're still going to be at a low utilization ratio because of the outstanding $10,000 unused revolving account. So when we say this, it's a global perception here.
Yeah, and following up on that, at Ox Publishing and Hutton Chase, for years we've offered credit to consumers as a way to give them new credit that's not negative, of course, and that's if they pay the bill on time, and of course the way to affect and balance out the utilization ratio. I believe I've got thousands and thousands of experiences here where the consumer adds those, the largest line of credit that they can, and it does, without a doubt, lower their utilization ratio. And a couple of the evidences of that is that if you look at most credit monitoring reports, it gives you a utilization ratio, and that is across the spectrum. However, I personally do believe you're better off if you lower, all of the utilizations as much as possible. But to say, as this bullet point number 3 does, is that that should you spread out the debt from a FICO algorithm standpoint, I'm not sure that it matters. Kelly, you may be able to speak to that more clearly than I can. But I think from a lender standpoint, you're better off with lowering as many cards as you can, rather than having them spread out evenly. I'm not sure how important that is.
Well, and we used to have arguments with John over this. When I first came into the business, I was trained by Edward Jamison, and Eddie and John would go back and forth on this even at a conference. They had a little thing going back and forth, and Eddie kept saying, you need it all at 25% instead of one card at 100, and John kept saying, no, it doesn't matter, it doesn't matter. And he finally was able to convince Eddie by showing him some statistics that it really, truly doesn't matter. If it hurts you more than it helps you, because what John will tell you is it makes you have 4 cards. Let's say you've got 4 cards and you put $2,500 on each card. Now you have 4 cards with open balances versus if you only had 1 card with a higher limit. You don't want to have it maxed out by any means, but having an open balance on more cards will hurt your score more.
Yeah, so very good point. Said differently. So you're better off with a 0 balance on a credit card than a $1 balance. Would that be a true statement?
No, because what John has said is that you would like a 1% balance.
Okay.
So it's really difficult, though, to calculate and have 1% on that card. So then in that case, he would say it's better to have a 0 balance than try to keep a little bit on there and maybe forget the payment.
Yeah, so talking about that, Joe, when we say 20%, well, a lot of people say 30, others say 40, others say 25. Really, what we want to be is as close to 0 as possible. That's the number. What the consumer needs to do is lower his balances. The lower he gets on his utilization ratio globally, the higher his score, or the less amount of points it will leave on the table with regards to utilization. And remember, utilization affects that FICO score at around a rate of 30%. So that is a number that definitely moves that score up or down.
And another aspect of the utilization ratio is it has no memory. The FICO algorithm has no memory as regards to utilization. So literally, if today is the day that the account closes out and you pay it off to 0, your score will be lower when it reports. Your score will be higher when it reports immediately, and it does not remember the fact that you were maxed out last month.
Absolutely.
Yeah. So another key aspect there. Yeah, I can tell you without a doubt, if you play with your own credit cards and you play with your own credit report by, literally, paying off a balance and watch the score change if, of course, it was in a microcosm, which is very difficult for that to occur. But you can literally, make your utilization rate, you can affect your utilization ratio by paying off or paying down substantially a balance, and you can actually watch the credit score go up in every instance I've ever seen personally. It just immediately happens, just like adding new high-limit credit cards to the mix. Back when we did 10,000 lines at Ox, they flew off the shelves, right? Because it would just vastly affect most people's utilization ratio. Now we're limited to much lower limits of 2,500, but still the average person, that will substantially help as well.
Yes.
And of course, the fact that they've got bad credit or don't have any good credit, it's just very important to get somebody good credit or credit that's not bad on their report, or otherwise, you're just not going to begin to get any traction whatsoever.
Yes.
I have a client right now, and that's exactly what we're going through with him, is he doesn't have any good credit on his credit report. We've gotten negatives removed. We've gotten things removed. And just yesterday he called in the office and was talking to Jasmine, and she was telling her, he needs to get some credit. He needs to talk to Kelly about getting some credit, and he can't understand why we're not increasing his score. And so I had to go over it with him to let him know, you've got to have some good in with the, not only take off the negatives, but we got to have some good to help your score go up.
Yeah.
Yeah, it works. I used to say it works like magic, right? Well, why does it work like magic? Because the FICO algorithm, just is affected by the outstanding or the new credit that's applied. And of course, then you got somebody say, well, you shouldn't apply for new cards. That'll lower your credit limit. Well, if your credit's 500, look, this can go virtually no lower, right? So, go out and worry. Don't worry about that aspect of the FICO algorithm. Worry about the ones that affect your credit more, which is, the ones we're trying to improve. And of course, Kelly, as you know, if you talk about this during your presentation, both with the consumer as well as with these the industry that we were trying to impact with this CE course, if you tell them that, it'll demonstrate the fact, first of all, you know what you're talking about, and then with the consumer, you set them up for success by saying, look, we're going to be needing to do this, and so, begin to plan for it, go ahead and do it now.
Right.
Yes.
But otherwise, you're having that conversation. You're taking off all these negative items, my credit score is going down, you're not doing your job. One of our new customers, Ron King, just sent me an email earlier about a guy, let me look at his name here, Terry. Let's see, what is his name? Terry Clemens, Executive Director of the National Consumer Reporting Association, and he was at the Greater Indianapolis Mortgage Brokers Association, telling the owners of the mortgage companies not to refer their clients to credit repair companies, that they could be held liable, et cetera, et cetera, et cetera. Well, of course, this guy doesn't like us whatsoever. He's the Executive Director of the association that represents the big three credit reporting agencies as well as employment screening companies, et cetera. And I think I said to Joshua the other day and to others as well, if the BBB's right, and I presume they are, and if the FTC is right, and I presume they are, and if the Executive Director of the National Consumer Reporting Association is right, and that you can't remove items that are accurate, okay, my answer is, okay, but since we're getting hundreds of thousands of items off a month, you must be so screwed up because all these weren't accurately reported, right? And so, I want to turn the tables on these guys and say, well, if you're removing millions of items a month, you need to concentrate on fixing your problem rather than worrying about us, right?
Yeah, that's the fundamental issue. The system is flawed. They know it. There's been a lot of different suggestions on how to improve it. They don't want to invest into it, and they oppose it. So they're really taking care of the symptoms instead of taking care of the problem, and they're doing it in their own way. I agree with you, Joe. They need to fundamentally control a lot more of the reporting, and it's really not their. I don't think it's their fault because they're not self-regulating as well as they could. A lot of these problems start when the actual their different portals or the data furnishers are using their portals. So the information starts, from the moment that the client is at the dealership, and there's no rules for that, and there's no verification on that. When I was in the car business, if I had a social security number and a name, I could pull credit. I didn't need the address. And I could set those parameters on a TransUnion portal. So guess who sets themselves up for failure? Well, every time one of my sales managers pulled credit for a consumer, all he needed was 3 items, when he should be entering all of the items and making sure that they're verified, and if they aren't, go ahead and provide evidence that they've got new addresses and new places of employment. They've got to provide that. If they can't, that's when it needs to start. But it gets complicated. It affects the way of doing business, what way companies do business. There's a lot of change around that, they can't deny that causes issues, and that's the reason why this whole space exists. We didn't invent the system. Now let's go back to this point about removing things that are correct. Well, I don't know of any credit repair organization that has ever removed a line item, Joe.
Right.
I think it's impossible.
It's not our job. It's not our job to remove. We can't. I can tell you. We cannot remove a negative item.
Exactly. So credit repair.
We can't remove any item.
Exactly. Credit repair organizations do not remove anything. All they provide is a quality deliverable. All they do is basically put together a letter and dispute on the consumer's behalf based on the consumer's requests or however they're doing their business. Now, let me tell you one thing here. What has caused a lot of great misconception is when people started doing this in the early 2000s and way before that, in the 1990s and stuff like that, what they were doing, Joe, was basically saying that everything on there doesn't belong to me or was paid as agreed. Now, that's just wrong. And if you're out there on this call and you're a credit reporting organization, you're a credit repair organization, please stop doing that. There are other ways to engage these line items. We call that factual disputing, Joe, at SCORE. And the way we do that is by basically verifying and looking at a line item in 3 different ways. Number one, when something is obviously incorrect, the consumer knows it's wrong because he just knows it's wrong. Like a name, an address. He knows his name, he knows where he lives. If that's obviously incorrect, well, then you can say that type of, you can use it doesn't belong to me or it's incorrect, a definitive statement. If there's something that's obviously missing that should be on that report, like a balance. If the balance is not there and there's an open account and it's a revolving account with just a high balance, well, I don't think that the utilization ratio is going to calculate correctly. Well, that's important. And if it makes it derogatory, well, we can verify that. So if something's obviously missing, we can challenge it. And if there's everything else on that, everything that is unrecognizable by that consumer is verifiable. And Joel, that is the law. In order for something to be verifiable, you've got to ask the question, is it correct? And they're responsible to answer. The Fair Credit Reporting Act is clear, and its intent is to protect the consumer. And the intent is to place the burden on the data furnishers and the credit reporting agencies to perform the dispute process. The ones that are deleting, that guy is absolutely correct. We cannot delete anything. Only they can. But if we all start disputing factually, guess what? They've got no other excuse because we're doing exactly what the law provides the consumer the ability to do so with.
Exactly.
Yeah, and there's the consumer's right to do it. And of course, anytime that somebody says, "Hey, you don't need a lawyer, to represent you in that," come on down here, let's just talk about that. Or they say, "You don't need a credit repair organization, you can just do it yourself." I put the same, I give the same two issues the same amount of scrutiny. I'm wondering who's trying to screw me, right? Because, to tell me you don't need a lawyer, to say you don't need a credit repair organization, you can just bumble your way through this yourself and do it yourself. We'll treat you fairly. One time years ago, we had a housekeeper that, we gave out 1099s to because, we paid her several $1,000s. And, she and her husband came knocking on our door one day and says, "Why did you give us this 1099? I says, "Well, because, we paid you several $1,000s. And we're obligated by law to do that. And, so that's why we did it." So long story short, she goes over to the IRS and to get them to help her do their taxes, get them to help her do her taxes. And
right.
She said, "I had to pay X number of dollars in taxes." I went, "Okay, well, so what, not surprised, right? You got paid, you got to pay taxes." And I said, "Well, let me ask you a question. Did they ask you for any of your deductibles? Did they ask you how much money you spent making that money? Did they ask you for any of your receipts?" And she said, "No, they didn't." I said, "Well, then shame on you for going to the IRS to do your taxes, right?" They didn't care about how much she had spent to make that money. They just wanted to charge her as much as they could in taxes. So the same thing, as far as I'm concerned, goes for the credit reporting agencies. The consumer is given the opportunity to have a credit repair company, and I can't wait to get a hold of this Terry Clemens, but screw him for telling people that they shouldn't go get a credit repair organization. And here you got the executive director of this organization saying that. Carries a lot of weight, but I can't wait to engage him to demonstrate to him why and how often consumers are benefited by, the engaging a credit repair organization. I mean, it's just crazy, and I guess it's the law too. So,
Joe,
my opinion, I'm not surprised, but
my opinion is it's un-American, and let me tell you why. I'm passionate about this. So you touched the nerve here. The IRS, when we went into this, let's call it decline in our little mini depression or recession, right? When we had the mortgage bust, the IRS years later came out with a lot of programs to help the consumer. Here you have the consumer, they're losing jobs. Some of them they were just incorrectly they were placed into the wrong loans, and this whole thing just snowballed for many reasons. And we're not going to go into that, it's very complicated. But the reality is that the government started in 2011 before that, but one of the initiatives that the IRS did was, a lot of customers had tax liens for IRS tax liens as well as state tax liens that were not paid. And specifically with regards to federal tax liens, what they started doing was, number one, automating the way that consumers could go ahead and engage the IRS to really decide to pay them back. They automated a way to go ahead and get their payments in to the IRS. It was a very complicated process to establish a dedicated account. Okay, it was a very complicated process to negotiate an outstanding debt. It was a complicated process to negotiate a debt at lesser than the amount owed. That was unheard of. Now, what they started doing was automating that. And the reason why they started doing it was because they figured one thing out. They said the consumers are getting back on track. And if government hurts or penalizes and makes it difficult for consumers to go ahead and get back into buying again, well, it hurts our economy. And we've got to be very careful with that. There's an important and inherent responsibility by both big business and small business and the government to regulate this, because consumers need to go ahead and start lending, achieve, getting loans and start spending in order for the economy to burst. And this is important. As a matter of fact, in 2011, the IRS Fresh Start program was enabled. Now, and we'll talk about this, ladies and gentlemen, on next week's webinar, but I just want to give you a prelude to what we're going to be talking about. This Fresh Start initiative basically gives every consumer the ability that has an outstanding federal tax lien that has been able to establish a payment plan with the federal government. They have to pay at least 3 times, have to have executed at least 3 payments. It basically lets them go ahead and establish a payment plan with them and to have their tax lien completely expunged from their credit, Joe. Completely. You don't have to wait 7 years to get that removed. As soon as you've established the requirement, which is pay 3 times on it, you can go ahead, fill out a form, and we'll explain that, how to do that, and why it's being done, and the whole idea around it. There's a lot of things that we need to know in order to do this. But fundamentally, you know who asked them to remove it? The IRS does. The IRS asked the credit reporting agencies to take that off on the consumer's behalf. And it's done through a 12277 form. And we'll go into that, and exactly we'll show you what the forms are next week, because this is something that you can do for your customers, and we at Score can help you as well if you're already a customer. But it's an excellent way to get out. Not only that, customers that have already paid off tax liens can do that. So these are a lot of myths that we're going through and a lot of things that we can do for our consumers. Look at all these myths that are on there right now. The purpose of this presentation is to really establish yourself as the undisputed expert amongst your peers, ladies and gentlemen. And this is what you should do so that you can go ahead and get that referral business. Next week on our webinar, I'm going to be doing this. I would like to have Kelly again on this, because we've actually done something like that for her a couple of months back, and people are paying off their tax liens, and some of them don't have enough money to pay it off on one lump sum, but they can negotiate a payment 3 months later, get a tax lien removed if they are 3 to 4 months later, so they can remove it. That's a great thing. And guess what? If they fail to pay on it, well, you know what? They fall back in, and there is no second chance. But shame on you if you did that. Okay? But once again, Joe, it's just something that I'm very passionate about with regards to the role that big business and government play in fixing our economy. And this is definitely getting people back to spending money and getting loans and big loans and buying homes and buying cars again, and doing it in a responsible and ethical way is the way that this is going to be corrected. And the credit repair business is always going to be in business, ladies and gentlemen, because the system is flawed. They've got to change the whole system in order for it not to be flawed.
Well, Joshua, we've got a lot more slides here, but I'm glad that everybody's been on the call. It's a little after 4, so let's end today's call. Kelly, it's always great to have you on. I will not be on next Thursday's call, but Joshua and Kelly will carry on. And Joshua, it seems like a great topic. I know everybody will be excited to be on the call and put that on your calendar to learn more about, and about Score services as well.
Well, thank you very much for everyone being on the call this week. Joel, sorry to see you're a little bit, you've got this laryngitis going on, but we hope that you'll be able to be a little bit better the next time you're on. And thank you very much, Kelly, as well. Once again, Kelly's one of our customers, and she's been down here for 2 weeks, and she's had a great time. She's actually cooked for us, Joel, twice. Wow. I've gained 3 more pounds, by the way, 3 more pounds. But anyway, if you're a Score customer, you can always visit our facilities if you want. We're one of the only customers or companies that'll show you actually what we do and how we do it. I don't think anybody else does or is willing to do so, Joe, but we do. Be sure to be on our next Tuesday webinar as well, and we're also talking about our Scoreway solution as well for all of you that qualify for that as well. So thank you once again for being on our webinar.
Thank you, Kelly.
Thank you.
Have a good day. Bye-bye.
Bye-bye.